In the United States, credit cards are a normal part of everyday life. People use them to buy groceries, pay bills, book travel, and manage expenses. But for many people, credit cards are confusing. Some see them as helpful tools. Others see them as dangerous debt. The truth is simple. Credit cards are neither good nor bad. They are tools. Used correctly, they can help you build credit, manage cash flow, and earn rewards. Used incorrectly, they can lead to long-term debt and financial stress. In this video, we will explain how credit cards work in the United States. Simply, clearly, without hype, without promises, and without selling anything. Let's begin. Section 1. What is a credit card? A credit card allows you to borrow money from a bank or financial institution. When you use a credit card, you are not using your own money. You are using the bank's money. Later, you are expected to pay it back. Every credit card has a credit limit. This is the maximum amount you are allowed to borrow. For example, if your credit limit is $1,000, you cannot spend more than that amount. Each month, you receive a statement. The statement shows how much you spent, what you owe, and when your payment is due. If you pay the full balance by the due date, you usually do not pay interest. If you do not pay the full balance, interest is added. This is where problems often begin. Section 2. Why credit cards exist. Credit cards exist for several reasons. For banks, they generate profit through interest and fees. For consumers, they provide flexibility. Credit cards help people pay for emergencies, smooth cash flow, and build a credit history. In the United States, having a credit history is important. Your credit history affects loan approvals, interest rates, renting an apartment, insurance costs, sometimes even job applications. Credit cards are one of the easiest ways to build and maintain credit history, but only if they are used responsibly. Section 3. How credit card interest works. Interest is the cost of borrowing money. Credit card interest rates are usually high. Many cards charge between 15% and 30% per year. Interest is calculated when you carry a balance. This means if you do not pay the full amount owed, the remaining balance starts growing. For example, you spend $500. You pay only $100. The remaining $400 accrues interest. Over time, this can become expensive. This is why credit card debt can be difficult to escape. Paying the full balance every month is the safest approach. Section 4. Minimum payments. Every credit card statement shows a minimum payment. This is the smallest amount you are required to pay. Paying the minimum avoids late fees and keeps your account in good standing. But paying only the minimum is risky. It keeps you in debt longer and increases interest costs. Minimum payments are designed to protect the bank, not the consumer. They should be treated as a last resort. Section 5. Credit utilization. Credit utilization refers how much of your available credit you are using. For example, if your credit limit is $1,000 and you use $300, your utilization is 30%. Lower utilization is generally better. High utilization can lower your credit score. A common guideline is this: try to keep utilization below 30%. This does not mean you must avoid using your card. It means you should manage balances carefully. Section 6. Payment history. Payment history is the most important factor in your credit score. Late payments can stay on your credit report for years. Even one missed payment can cause damage. Setting up automatic payments and payment reminders can help avoid mistakes. Consistency matters. On-time payments, month after month, build trust. Section 7. Types of credit cards. There are many types of credit cards in the United States. Some common categories include basic credit cards, simple cards with no rewards, cashback cards, return a small percentage of your spending, travel cards offer points or miles for flights and hotels, secured credit cards require a deposit, often used by beginners, student credit cards designed for first-time users. Each card type serves a different purpose. Choosing the right card depends on your situation. Section 8. Fees to watch out for. Credit cards may include fees. Common fees include annual fees, late payment fees, foreign transaction fees, and balance transfer fees. Not all cards have all fees. Reading the terms is important. A card with rewards may not be worth it if fees are high. Simple is often better, especially for beginners. Section 9. Credit cards and emergencies. Credit cards can be useful in emergencies. Medical bills, car repairs, unexpected travel. But they are not a replacement for an emergency fund. Relying only on credit can lead to debt cycles. Ideally, emergency fund first, credit card as backup. Preparation reduces stress. Section 10. Common credit card mistakes. Some common mistakes include spending more than you can repay, paying only the minimum, missing due dates, maxing out cards, applying for too many cards at once. These mistakes are common and avoidable. Awareness is the first step. Section 11. How to use credit cards responsibly. Responsible credit card use is simple. Spend intentionally. Pay balances in full. Track due dates. Keep utilization low. Review statements regularly. Credit cards should support your financial system. They should not control it. Section 12.
credit cards, and long-term finances. Over time, responsible use builds credit. Good credit lowers borrowing costs, increases financial options, and provides flexibility. But credit cards are not a shortcut to wealth. They are tools for management, not income. Long-term stability comes from planning, saving, and discipline.
Credit cards are powerful tools. They can help you or hurt you. The difference is knowledge and behavior. Understanding how credit cards work allows you to make better decisions and avoid unnecessary risk. Learn, adjust, improve. Thank you for watching.